Okay, compound. All right, let me see where all my people are at. Mike, we missed the show last week. People were emailing.
Yeah, it's been a long time.
People were like, yo, tell me this shit is coming back. Totally, it's coming back. Steve Leon, what's going on? Chris Reardon, Tim Shaughnessy, John Ricker, Warren Z.
Warren Z.
Warren Z. Miami boy.
Warren Zuffett.
Yo, everybody's here. All right, we got a big audience tonight. Shout out Ian Dunlop. Thanks for coming through with the pandas. You know we love all y'all. This show tonight is dedicated to Norm Macdonald. Nobody tells a joke like Norm Macdonald. Oh my God. R.I.P. One of the funniest of all time, and it's not even up for debate for me. For me personally. All right, we have a lot to get to. A lot of economic stuff, some market stuff, some crypto stuff, some regulatory stuff. Very exciting. But before we do, shout out YCharts. YCharts is the best sponsor in the world. Galaxy for all financial media. YCharts is ride or die for the compound. They love us and we love them. If you guys haven't tried out YCharts yet and you like doing your own research and analysis, there's a link right below this video. If you're a first-time user, you can register and get a lower price for trying it as a result of watching the show. So go check it out. Love you, YCharts. All right, number one. I don't know if I'm going to say the economy's tanking, but it looks like optimism is tanking. And you have this combination right now of the surprises being negative. You have some very large, important companies reporting warnings based on the broader economy. Whether you believe them or not is your choice, like what their excuse is. But Sherwin-Williams, like some pretty good operators and some pretty notable names. PPG, I forget which other ones that I saw. And now you have all the surveys coming in negative. So this is the one I wanted to share in particular, so we don't have to go through all of them. And this is via Bank of America. They do a survey on expectations for economic growth, and in August it plunged 14 percentage points. In September versus the August survey, it plunged 14 percentage points, which is a very big month-over-month fall. And Brian Westbury at First Trust, I think, does a really good job explaining why we should expect that. And then I want to get your take on this. He's basically talking about the fact that retail sales in July were 17.5% above the level they were at in February 2020. To put that in perspective, in the 17 months before COVID, retail sales were only up 5.1%. So you can't really have retail sales growing 3 times their normal rate unless the government is spending all this money. And that's now obviously over. Retail sales are important because they're 30% of GDP and the consumer is 70% of GDP. So if we know that's falling off, is the market already pricing this in? Or like what would you say the mood of the market is right now relative to what's happening with economic optimism, which is clearly fading?
At least the stock market's not up 20% year to date, right? So it's not like we're pricing it to slow down. There's no way it can go down, right? So that chart where it's showing profit expectations, is that the chart that you're talking about?
Yeah, 14%. I don't know. Do we have this one? I don't know if we have it.
All right, so the prior peaks, and just to be clear, what this is showing is a survey that profit expectations looking forward will decline. We saw a big decline, right? Okay, makes sense given where we come from, where we might be going.
This is profit expectations for the S&P 500.
The prior times we saw these steep declines, December 2009, not a bad time to put money to work. February 2002, not a bad time to put money to work. In other words, I'm not saying that this time is going to be as good as those times. I'm just saying I don't give a shit about the survey. I think that's what I'm trying to say.
Well, would you give a shit if next month gets worse than this month and we start to see a trend and the economic data really does start to confirm what people in the survey are worried about?
Well, hold on. What are we talking about here? Are we talking about, what do I care about? Do I care about the stock market or the economy?
Okay, so that's a really important point. I think that you're going to see a lot of headlines as these surprises continue to come in negatively. you're going to see a lot of headlines that are conflating the two things. And that makes
totally.
And what that can have the impact, it may not have an impact on the economy or on profits, but it could definitely have an impact on the multiple. And if people start to get into the mindset that we've already seen the best that we could see, you could have continued multiple contraction, which we've already seen starting in January. So for the S&P.
If you look at some of the names that are most sensitive to the economy, look at materials, energy, industrials, financials. They all look heavy. Now listen, can that turn around?
They're rolling. They're rolling.
Yeah, can that turn around tomorrow and this will be a bear trap? Yeah, sure, of course. But they look a little bit heavy. And guess what? Who cares? I mean, I know we care. I know as investors we care. Nobody likes drawdowns. But we need a drawdown, okay? The stock market is up 20% year to date. Oh, it's a market of stocks, whatever. The S&P 500 is up 20% year to date. It has not even fallen, declined more than 3.5%, 4%. It's enough. We're allowed to give back some profits. And guess what, Josh? When we do, if we do, then the headlines are going to come out like, is the economy slipping?
The headlines,
double dip?
The headlines in a 5 to 10% drawdown for the S&P will be pitch black.
Do not look.
They will be the darkest, gloomiest headlines imaginable. And the thing is, though, it's not going to be fake news. It's going to be accompanied by economic data that is either surprising to the downside or decelerating.
Fine, but
versus 2020, and of course it's decelerating.
Of course, no shit, it has to. But earnings are at all-time highs.
Right.
So if earnings don't hit the highest bar that they've ever been for a quarter or two, we'll be fine. We'll be just fine.
It's so funny that we're going to go back. We're going to go back to the old playbook of low interest rates and buybacks.
By the way, rates fell.
Taking the slack back from the economy.
Rates fell a good deal today, and I think Lizanne Saunders tweeted a chart. Somebody did. Maybe Bank of America buybacks through the roof. Dude, you know what? I'm ready to talk about the stock market.
We predicted that shit all year, that buybacks were going to come back.
Let's talk about the market. It's been so boring. I'm ready to come back to it. Bring me back.
Yeah, look, we're up 18% year to date, give or take, and now the economic data is going to decelerate. Arguably, I think you're right. Maybe we should be up more like 15 or 12%. The problem is people only remember where the prices were a week ago or a month ago. People anchor to the highest price in their portfolio.
Dude, don't get me wrong. I'm definitely going to freak out.
Yeah. All right. Well, I'll be here for you. Okay. What do you got?
Okay. All right. It's enough. It is enough with these Congress people trading.
This is worse than Congress. These are Federal Reserve voting members.
That's true.
Insane.
That's true. These are people that are actually making monetary policy. What the hell? And trading mortgage REIT stocks. This is criminal.
Why do you have to do that?
Work for the Federal Reserve or for Congress, you have to buy an index fund. Tough shit. Get rich. Yeah. Get rich after.
So this is the why do you have to do this? You're already rich. By the way, do you know how rich you have to be even be in the conversation to be a Federal Reserve board member? These are not people that are starting their careers. These people have worked as economists for banks. They have millions of dollars.
How do you think Ben Hunt felt when he read this?
That dude's going to have a fucking coronary.
One of the Federal Reserve's largest internal critics of the risk in the U.S. real estate was an active investor in the sector last year, Financial Disclosure Show. No big deal. Listen, he went through the proper procedures and channels. He documented his trades. Okay, how about this? Boston Fed President Eric Rosengren listed stakes in 4 separate real estate investment trusts.
Why?
And disclosed multiple purchases and sales in those securities.
What are you doing? Just trade crypto. There's no conflict. Listen, I was reading about this and just saying to myself, I get it. You're a private citizen. You happen to have a job at the Federal Reserve, which
No. You're not a private citizen and you happen to work at the Federal Reserve.
Well, they're not elected. Michael, wait. They're not congressmen. They're not congressmen.
They're making public policy. I don't care if they're elected or not.
I don't like it. I'm just drawing a distinction between somebody in the Senate that's literally passing laws versus somebody in the central.
It's a distinction without difference.
You know what though? I just feel like I don't understand. I feel like what I'm missing is why they can't just wait till they're done. They rotate into and out of the Fed. And after the Fed, they end up at KKR or Bain or some private equity firm, make another $1 zillion, and then you could trade your ass off.
Right.
Do whatever you want. Can you just do 4 years, 6 years at the Fed and like keep your hands in your pockets? It makes absolutely no sense to me, especially the mortgage REIT thing, which is like literally in their purview. Come on.
Should we buy $40 billion this month? Yeah, I think so. Ooh, that's a good one. How about that stock? That mortgage REIT stock, that's a good one.
This guy Robert Kaplan, I get it. He was a Goldman Sachs guy. He's probably been trading every day of his life. Multiple $1 million plus transactions last year as the U.S. economy was convulsed by COVID-19. Oh, you weren't busy?
Also, how about some common sense?
You didn't have anything going on.
What do you think? How do you think this looks?
Well, that's the point. It's not that we think you're doing something ill. It's not that we think you're like manipulating the markets to make your REITs go up. It's the optics.
No, and like I said,
Use your brain.
They need approval for all of these trades. They're all documented. Fine. So what? Enough.
Yeah. Why even get this approved? You know what? The person who approves this should look this guy right in the eye and be like, why? Like, so why do you have to do that?
What's your stop?
What is the benefit of this? You're going to make 8% on a REIT? What is your point? All right,
they probably made like 90% on those REITs.
I don't want to say anymore because we're going to look to hire some of these guys when they rotate out of the Fed and have them as like people that go out to steak dinners with our clients. So I don't want to upset all of them. There might be some value in maintaining a nice relationship. I guess I would just bottom line by saying, why can't these people just do the job they're being paid to do and then make all your money after?
By the way, this is why Robinhood's a good business. Trading is addictive, especially social media trading. All right, go ahead.
All right, you did a really good blog post, which is surprising to me because.
Thank you. I'll take that backhanded compliment all day.
I read all your stuff, but this was really good, and I wanted to share this with the audience, and I wanted you to elaborate a little bit on what you were trying to say. Business is booming. Should I quote you or unnecessary?
No, what's a TLDR?
I think what you did here was really good because you brought together a lot of different markets and a lot of like some of just the extraordinary statistics about everything from funding startups to launching companies, and a lot of this stuff is global. It's bigger than most people realized. But some of the stuff that I wanted to just have you comment on. This first thing, global funding to startups rises to an eye-popping new record. In the second quarter of 21, $156 billion in closed real investment came into startups. That's 90 days, $156 billion in checks being written, basically, not stocks being bought. That's unbelievable.
That's like 10 trillion a second. That's crazy.
So, all right, I spoke with somebody this morning who wants to launch an angel fund by subscription. He wants to be the Netflix of angel investing. He wants wealthy people. No. He wants wealthy people to just like commit to like $1,000 a month, and he just like sprinkles it into startups. And I'm like, well, how are you picking? How are you? And we got into a really good conversation, but like this is now as mainstream gets. And the lines, we've said this before, but the lines are so blurred between private and public.
How about corporations like are big players in venture capital these days?
Oh, do we have that chart? I didn't know it. I didn't know that much about this. These are CVC backed deals, corporate venture capital.
I think Coinbase did like 90 deals in the last 12 months. They're buying everyone. So anyway, yes. All right. So Mark Andreessen Horowitz just raised a $400 million seed round.
Seed fund.
Seed fund. Yeah. I'm sorry. And they led their investor letter or their public letter with, there has never been a better time to start a company. So if you look at a chart of business applications, usually in a recession, they crash because people don't start businesses in a recession. Businesses shut down. So I have personally, and I'm sure you have too, spoken with more business opportunities on the product side and on the potential investor side this year than I have ever. And These are people that were leaving Dropbox and Uber and Google. Like these are well compensated people that are like, I'm out. Now is the time. It's easy to get funding. It's easy to go from 0 to 100. Like this is, and so the point that you just made about what was it, $156 billion. So let's say that you think some of these companies are bubbles. Let's say you're like, oh, Top Shot is bullshit. Yeah, guess what? They just raised, and I'm making up, I forget what the numbers were. They just raised $1 billion. They're not going out of business tomorrow. Right? So I think that's the difference between
if you raise $1 billion and you have less than 500 employees, you could pivot 6 times before you figure out a way to make money.
Right. So these companies have runways. So it's not
which is so different than startups of a different era. Like like people pointing to like 1997 or 1999, what they're missing is that those companies raised $50 million in the public market and had burn rates of $5 million. They were done in 10 months. These companies are raising $1 billion.
Right.
How are they going away?
So
and they're privately traded. You don't even know what the stock is worth.
The valuation might be high, whatever. The investors might not do well, whatever. These companies are not just going to tank and disappear tomorrow. They're too well capitalized. And I think that's like a really important part of it.
Now, here is the not so great news.
Hit me.
The downside to everybody being so well capitalized and well funded, and they're just being like these competing war chests of cash continually funding these companies, is that they may end up in total, in aggregate, destroying a lot more economic value than they create. By way of which, I mean, they end up competing with each other before somebody can get a foothold in a market and become profitable and figure out a business model. There could be 5 versions of that company competing all the profits away, living off of this cash that they've raised and not even worrying about the economics of a business. They would call this in another context, Michael, they would call these like zombie companies if they were on the way down. They're brand new. They're not zombies. They're on the way up. But it's not healthy to have thousands of companies that don't have to make money anytime soon.
I'm sure certain industries will not pan out for investors. Just the industry dynamics of competition will not lend itself well to profits. But
this slide you included here, the Solana ecosystem,
it's hilarious.
I'm guessing there's 200 different companies on here. Are they companies, or did somebody buy a URL and a logo and say I'm a company?
I don't know.
A lot of these are probably going to be the latter.
I don't know.
But not my problem. I'll fund them anyway, just because I almost feel like it's fish in a barrel.
I want to talk about the App Store. You know, when this news came out last week that Japan made a ruling that looked unfavorable towards Apple, the stock was up the next day.
Because people expected a worst case scenario, or
I guess
some people expected a worst case scenario.
$2.5 trillion company. All right, so here's the deal: gaming app accounts. So it's Epic versus Apple. Gaming app accounts for
Let's set the stage. So Epic Games is the company that makes Fortnite. They tried to create a payment mechanism within the game that was a workaround from Apple's App Store.
Why?
And Apple shut them down. They had a standoff, and now it's in court. And it appears as though Apple beat Epic in this fight. Epic says they're a monopoly. Apple was able to prove, no, we're not. And so it looks like on the surface, Apple got a victory here. Go ahead.
But yeah, you're right. They didn't. I don't think they won. They won in the short term. So Scott Kapoor from Andreessen Horowitz said, under Section 2 of the Sherman Act, the threshold for a monopoly is 65% market share. Apple has 53 to 57. All right, close enough. So
you know why that's so misleading? Because in reality, Apple does have a monopoly. Like myself and everyone I know has an iPhone, and the iPhone does not compete with the device of any other company because nobody would even look at one. It's a de facto monopoly amongst, I think, middle class, upper middle class in cosmopolitan cities.
They take 30% of all revenue on the app. However, it's 15% for apps with less than $1 million in net sales. All right, so that's generous, I guess. Throw up this chart of the trailing 12 months of revenue. So what we're showing here, the App Store, all right, this is a little bit misleading. So the App Store, this is 2020. In 2020, the App Store did more revenue in 2020 than all of these companies have done over the last 12 months. So
That's
is that
shocking.
maybe, I mean, come on. Look
That's
at this.
shocking. The App Store does more revenue than Disney. That's one of the most shocking things I've ever seen.
Now hold on. I have to say that Disney was hampered by the last 12 months. You understand?
So no theme park, but so what?
But still, so what? Boeing,
Yeah.
Pfizer, Cisco, Goldman, the App Store. So, okay. So this, I don't know who this person is, but there was a blog post from MG Sigler, and he made a great point. He said, Apple should open things up to win these arguments on the product side of the equation, not making these like nonsensical legal arguments.
They've always done.
Something which they're uniquely situated to do, thanks to about 24 aspects of the iPhone. They should compete on the playing field in which they already have the home field advantage.
Let me tell you why I think that's right. And I think this is what they will end up doing. Someone within Apple is going to come to this realization. So what? Let people find their own ways to put billing into the App Store. We'll cut it in half. We'll go from a 30% take rate to a 15% take rate. It'll be great PR. Everybody will leave us alone. People are so fucking lazy in real life. They would not look for a payment workaround if they're buying something through an app. They just click purchase. Apple has the framing of the thing that you're looking at. It's built into their screen.
Yeah, but it's not the consumer's choice.
They can make it a default to just pay with Apple, or here are 3 other methods. You have to click this link to go to the other methods. Nobody's going to do it.
But I
Nobody's
think
going to do it.
I think the developers are going to make it such that it's going to be easy for the consumer to not have to jump through hoops.
So what? So what? Now, if Apple came out and preemptively announced this, the stock would probably take a 10 or 12% hit.
Yep.
If they came out and said, all right, here's the deal. Yes, we're right on the merits. However, we recognize that you have to evolve, and we want to work with our developers and whatever some consultant writes for them. They could come out and just put this whole argument to bed by announcing a big drop in their take rate. But Sigler is saying they probably won't do it. They're too arrogant, and they don't feel like they have to. But I would say that would have a very short-term impact on the stock. Just like every time Facebook has to pay a fine or conform to some new European Union thing, and then the stock is right back to making new highs right after. That's what I think would happen with Apple. But he's saying I don't think they'll do it. What do you think?
No, they're not going to do it. I mean, I don't know anything, but I don't think they're going to do it. Why would they? They just won. The court just ruled in their favor.
Apple is maybe the most important commerce platform in the world. What do you think about that statement? Globally, bigger than Amazon, more important. Yeah. My brother does a lot of mobile advertising stuff, and he deals with Fortune 500 companies, and they don't really bother spending time on Android users because people that are iOS operating system users have more money and spend more money. So it really is a de facto monopoly in a lot of ways, even if it's not like strict interpretation. They basically have the whole thing on smash. That's why it's a $2.5 trillion company, because everybody understands that, and that's a very important concept. All right, let's keep moving. We were going to talk about this value stock, growth stock thing. This is not like should you buy one, should you buy the other. I actually want to just make the statement and see what your reaction is. This whole thing needs to be rethought and blown up, and nobody should use this distinction ever again between growth and value stocks. These terms literally have no meaning anymore. This is a Wall Street Journal article documenting the fact that the Russell 2000 Value Index this year, which is designed to follow shares of small companies that are viewed as bargains relative to the rest of the market, is up 22% year to date. The Russell 2000 Growth Index is up only 5%. Why? Because AMC, believe it or not, is in the value stock index, and it's up 2,000% this year. And it's grown to an enormous size where it's very, very meaningful to that index. If we're saying that growth or value, small cap growth, small cap value, has any meaning anymore, I don't know how we're going to do that. And maybe investors need to not even concern themselves with these distinctions. Let me see this little small cap value. Say hi, Logan.
No, listen. You're right. I think what needs to happen, though, the indexes are weird.
You should scrap them. The whole criteria.
The indexes are very weird. They're reconstituted once a year. So AMC, which might have started as 3 basis points, all of a sudden is 1.5%. And guess what? Did you know that stocks can be in both the value and the growth index? So right. I don't know what the criteria was for why AMC was. Actually, I do know. AMC probably did screen as a value stock 9 months ago.
Yeah.
But now it's September, and they reconstitute once a year, so this is what it is.
Ugh. And then you know what the worst part of this is? Like, this is all in the back test now. Like, this is all in the historical data that small value had a great year, quote unquote, a great year in 2021. And like, if you live through it and you understand this, you know it's almost all because of AMC.
No. It's less than 2% of the 20.
Well, there's
plus
a few stocks like that in there, though.
It's not all AMC, not even close. Anyway, right. This whole stuff, it's boring. Move on.
Yeah, I think we just need to stop focusing on that distinction entirely. It makes no sense anymore. The markets have been so distorted by everything over the last 10 years. The meaning is completely gone. Okay, what are we doing now?
I disagree, but let's move on.
Well, what is this yearly spread chart? Should we throw this up?
For the first time in 5 years.
Chart on. You got this?
That the small cap value stocks have outperformed small cap growth. So,
wait. Say that one more time.
This is the spread. This is Russell 2000 value minus growth. This blue one is good for value, bad for growth. The previous 4 years, 2020 was the worst year for value ever, I think.
All right, so this was a comeback year in many ways. I guess. Congratulations. All right,
okay,
let's keep moving.
Gensler. Did you read this New York Mag article?
Yeah.
I don't like this. I gotta say, I do not like this. So
what do you like?
The journalist asked him, one defense of payment for order flow is that it lets brokerages offer free trading that in turn democratizes investing.
Yeah.
Which it does, right? I mean, I don't know about the democratizing part, but
the word democratizing is doing too much work.
Fine. Payment for order flow allows us to trade for free. So here's
the word you're looking for is subsidizes.
Whatever. Fine. Subsidizes.
Well, I'm saying that's what it is.
No, you're right. So Gensler said, can I just say something? It's not free. It's a misnomer. It is not free, and it costs everybody who goes on those platforms because the platform is doing multiple things. One, they're selling your order flow. Two, they're collecting data, and the person paying for the order flow is getting that data. There's an inherent conflict because your buy or sell order, is not necessarily competing in the market, so it is anything but free.
They're both right.
Stop. We're playing games with words.
No.
Come on.
There is a legitimate hidden cost, but that's not the argument to me. The argument is not whether or not free trading is free trading. Okay? It's a little
free
bit
trading is
semantics.
not free trading because another company is making money. Of course, it's semantics. Go ahead.
No, but to me that doesn't matter. This is the argument. The argument is whether or not anyone gives a shit. And I'm telling you right now, Robinhood users do not. They grew up with people taking things from them invisibly in exchange for free services. They got Instagram for free, Snap for free public Wi-Fi, Google. These are things that have given them hours per day of entertainment, enjoyment, information, and they understand that it's not free and that they're trading their privacy. So if you give 100 people the choice between a paid service with complete privacy or a free service with no privacy, 99 of those 100 people would pick the latter. Now, the leap between someone serving you a personalized ad on IG and scraping your personal data to someone scalping a penny from your trade on the Robinhood app is a tiny leap. And
it's not a penny. It's not a penny. It's a fraction. It's a fraction of a fraction.
Whatever. If you told somebody Tesla's trading at $750, you could buy it commission free, but maybe you could have gotten it at $749.50 if you bought it on a different platform.
Nobody cares.
The person would look at you like, who gives a shit? What are we
Nobody
talking
cares.
about? I think what the regulators need to do, though, is they need to get these companies to change the language and stop saying free. They should say subsidized.
Fine,
and
whatever.
then everybody would be okay with it, I think.
So if this is a problem,
it is misleading.
If this, it's not misleading. It is, trades are free. If this is misleading, I mean, if he doesn't like this payment for order flow, what about Facebook? What does he think about Facebook? Where the product is free.
That's not his purview.
I understand. So what about how Lindsay made the point, like Google is selling all of your words. Somebody emailed us. Listen, somebody emailed us and said, if the SEC gets rid of payment for order flow, which I would be very surprised if they do that. I'd be shocked. What's to stop Robinhood from showing ads to the user before their trade is executed? Can you imagine having to wait 15 or 30 seconds for your trade to execute while you watch an ad for Target?
Well, I'll tell you what is stopping them. What is stopping them is the law. We have rules about best execution, and you actually cannot slow somebody's order on purpose to fuck with them in any way, including showing them an ad.
I just feel like the payment for the attacking the payment for order flow makes it sound way more nefarious than what's actually going on.
I think that most people on the platform would revolt if Robinhood said, "All right, we're going to clean up our act. Trades are $5." And could you imagine Twitter that day? And 3 years ago, they would have been like, "Oh, $5, that's a great deal." Yeah. So the goalposts have shifted too much. And by the way, all of the other brokerage firms have fallen in line with free trading. So it's not going to go back. I think it's going to be about the wording.
We're all for investor protection, obviously. This just seems like they have a limited amount of resources at the SEC, and this feels like a waste of time.
Well, I think if they can get these companies to just be more clear about what the trade-off is and why they're able to trade for free.
Who gives a shit? It's not even a basis point.
If you think that your job is to make sure there's enough transparency for the end investor, you do give a shit. Like you're not a regulator. If you're a regulator and you're tasked with that, you don't want companies saying something's free when it's free but. And in this case, it's free but. There's a different cost.
99.79 decimals free.
So fucking say that. So say that.
It's
why is it so why can't they just say that on the website or on the app? All right. I think we're bringing in Duncan now. And Duncan and I bonded hard today. And Mike, you weren't there. Duncan, we went to Milos in Manhattan in Hudson Yards, which I had not been to. What a beautiful restaurant, right?
Yeah, it was amazing.
Duncan, what did you get?
Duncan had a rack of lamb.
Yeah.
No.
I had a great salad. I had a grilled vegetable plate. And then for
Duncan
dessert,
had an after dinner mint. Listen, we're sitting there. The place is empty. It's 11:59. By 12:05, not an empty seat. And Pharrell walks in. And that's it for me, the whole meal. I can't stop going like this.
Scott Farrell, the sports guy. How was Salt?
Salt was cool. We'll talk about it on Thursday. All right, Duncan, first viewer topic. What do you got?
Okay, so this kind of dovetails nicely with what Michael was just saying about protecting investors, or maybe protecting investors. I don't know. So Tim writes, love the show, would love a tequila recommendation from Josh. What do you guys think about the current requirements for becoming an accredited investor? Especially in the past year, it seems unfair that the already rich can invest in startups with insane upside, while small investors are limited to the public markets. I think an ETF-type investment vehicle that is spread across hundreds of startups would be something that a lot of small retail investors would love exposure to. What do you think about that?
Mike, you want to take this first?
Also, maybe just briefly explain what an accredited investor is for anyone watching that doesn't know.
I think you need liquid net worth of $2 million and a certain income level, and a certain level of a certain number of years investing, or no?
I think it's $200,000. You could just check this out. I mean, I don't even need to guess. Just Google it. There are certain income or net worth requirements, but I believe if you are a registered financial advisor, you are now accredited, even if you don't hit the traditional standards. I'm guessing this listener is not an advisor, but whatever. Tequila recommendation, Grand Mayan. Josh, remember we were talking about that ceramic bottle? We couldn't remember the name of it.
Yeah, it's my go-to. The white one. Doug brought us the black one.
Yeah, that was over the top. Thank you, Doug.
That's a layup. If you're not sure about a good tequila and you just want to try something new, Literally nobody dislikes this tequila. It is as good as any other tequila you can buy.
Okay, so in terms of the accredited investor laws, I think what we were trying to do when these laws were written was protect investors
From bucket shops.
and
From
so
scams.
at the time, these were very, very, very necessary. I think the lines are blurred. I think they probably could use some revisioning. And would smaller investors love access to startups? Of course they would. How do they get them in a way that is diversified? That vehicle does not exist today. So,
Okay. So really quickly, they have actually reduced the restrictions on this. The Jobs Act came along and made it easier for small ventures to raise money from family and friends who weren't necessarily accredited. There are limits to the amount of people you can have in these deals, and then there's a level above accredited, which is called qualified purchaser. So there are like layers to like who can be in these deals, and the companies have a certain threshold of how many of each type of investor. But then the next thing worth mentioning, Fidelity, which you can buy this fund right now. Fidelity's got several growth funds where they're investing in pre-IPO startups. And you might not like the results, but they were in Uber, they were in Lyft, and this was in a 1940 Act mutual fund. So T. Rowe Price is doing this, several companies, and I wouldn't be surprised if we see a rolling fund ETF. And by rolling fund, I mean quarterly liquidity as people are coming out and new people are coming in. And giving that fund the ability to buy private stocks. So I do think this stuff is on the way. The NASDAQ is launching a private market. They're certainly not doing that with the intention of just allowing the uber rich to be involved there.
And they're doing that with Citi and Goldman and...
Yeah. The NASDAQ's going to do a private market that de facto becomes a public market because people like Tim are going to be able to invest in startups on that exchange. And they won't be the only ones.
Investor protection. Balchunas just tweeted before. UBS is launching a 2-time ESG ETF or ETN, I should say.
Are you serious? What does that mean?
Why not?
They're
Exactly.
going to leverage ESG. Is that called virtue signaling? That is the most ridiculous thing I've ever heard. All right,
come on, where's the
We'll talk more about that.
So next, Duncan.
Right. Duncan, what else you got?
Oh yeah, the one other thing I was going to say on that topic is I think it's confusing to a lot of people just because it's like startups, are risky, but you can go buy Dogecoin on Robinhood. You know what I mean? Like I think that's where a lot of people are coming from.
There are contradictions in plain sight all over the place.
Yeah. Okay, so next up is from Ryan, who writes, suppose you're going on a mission. I enjoyed this one. Suppose you're going on a mission to Mars and you won't be back to Earth for 50 years. You have $100,000 in a Roth IRA and you won't have any access to any news or the ability to make trades from Mars. What are you investing in? Stocks, funds, or just sectors, more broadly? And yeah, they ask if you would YOLO into ARK or do a target date fund.
Oh, this is easy. Yeah, the 2121 target date fund. Well, so I guess I would need to know one criteria. Are we aiming like for the highest? You know what? No hedges. How about this? Here's my answer. Friend of the show, who's coming on the show, the Compound Show and Friends eventually, shortly, Eddie Elfenbein. Great person.
Mike,
what?
You're going to recommend his active ETF? He's going to be dead before this person gets back from Mars.
Stop it.
He's in his 50s. What are you asking of him?
I'm not asking anything of him. I'm about to give me a second.
All right, go.
Eddie Elfenbein tweeted, sir,
okay,
be suspicious of any investment thesis that heavily relies on demographics. Colgate-Palmolive is up 30-fold in 30 years. It ain't demographics, it's toothpaste. Colgate-Palmolive. Lock it in. My stock for the next 100 years.
Like people will always need toothpaste?
You don't think so? They're gonna disrupt toothpaste?
There can't be another brand that comes along and takes half their
Who's
market
coming
share?
into the toothpaste
What about
industry?
like CRISPR?
Have you ever
and then we never have to brush our teeth again.
Have you ever tried Marvis?
What are you talking about?
Have you
No,
ever
I've
tried
never
Marvis toothpaste? Okay.
Marvis, get out of here.
I'll send you a tube of Marvis toothpaste.
No, you will
and
not.
You tell me Colgate Palmolive is going to own this market for the next 50 years.
Is that Crest?
The only answer to
I
this
use
question.
Colgate.
The only answer to this question is Alphabet. You buy Alphabet, and Larry and Sergey's heads will be frozen. They will be directing the activities of this company for centuries to come. I think you buy the Nasdaq. I don't know. I think you just buy the Qs. Why is this so complicated? You figure based on the criteria of being in the Nasdaq 100, it's always going to be the hottest shit there is. It doesn't mean you'll always outperform, but if you continually have an index that's investing in innovative, fast-growing young companies,
Speaking of weird,
how do you lose over 50 years?
Speaking of weird, there's like airlines in the Nasdaq 100. That's not what you think it is anymore. I know it's 40% is those giant names.
They're not that big. They don't matter that much. I would just buy the Q. I would buy the Qs as a 50-year bet.
By the way, I do think you're right though. If I had to pick one of the big tech stocks to be around in 100 years, it's such a ridiculous premise. But I think it would be Alphabet.
It absolutely is, because people are always going to be searching for answers for things. They may not type it in. They may just like mentally search, but there's always going to be a need for answers to questions. And I think it's going to be hard to dislodge Google from that place, unless you know what I want. A blockchain coming that's going to take that away.
I want to be able to like download a book. Like there's so many books that I want to read, but like I don't have time. I just want to download them into my brain.
That's apropos of almost nothing. That was good.
It's a business idea.
No, I don't hate it. That's the Matrix. That's how Neo acquires knowledge.
I'm not that excited about the Matrix. I got to be honest. It's been too long.
All right. Good to see you. Good to see you. As I always like to do at the end of the show, I like to remind you guys, if you want to submit viewer topics, there's an easy way to do that. askthecompoundshow@gmail.com. I'm told there's also a contact form. We have a link. I think it's in the notes in the description below this episode. I'm not sure. If it's not, it will be next week. Make sure you guys don't miss Animal Spirits, all new tomorrow morning, every Wednesday morning, in fact. And this Friday, and all new The Compound and Friends. And we're going to have a lot of fun on that show, as we always do as well. Check out the Compound Shop at idon'tshop.com. Thank you guys for joining. Make sure you subscribe. Make sure you like this video. We will see you all very, very soon.